Hey, what's up, guys? Thanks for tuning in again. It's Bobby here with Growth View, and today we've got a great guest. His name is Carl Zoellner, and he's a professional at the legal side of real estate syndications and structuring syndications. We've also got our president, Samson Jagoras. But Carl, we appreciate you being here, man. Thanks for tuning in with us.
Thanks for having me. It's always fun to talk about some different issues and work on things that are tax and asset protection related. So that's sort of my wheelhouse. And yeah, I'm an attorney. So everybody hold your booze to the end.
There we go. Well, cool, man. Well, to open us up, give us a little just color on your background and, what's led you to this point of your career.
Yeah, so I grew up in Central Texas, went to college in Colorado, and went back to Texas for law school. And in between undergrad and law school, ran successful businesses for about a decade during the height of the recession. And eventually, in working with attorneys and insurance companies and things like that, I don't know, I guess you could call it cocky at the time, but I thought I could do it better. So went to law school, became an attorney, liked the idea of sort of being able to write my own check and, sort of pursue my own destiny. As I was coming out of law school, even before I took the bar, I hooked up with a great company. It's called Anderson Business Advisors, probably one of the biggest, if not the biggest, tax and asset protection firms in the United States. Last time I checked, I think we're about 40,000 clients in all 50 states. So it has been incredibly rewarding helping people, helping investors keep more money in their pocket, paying less in taxes, and also, staying away from those pesky plaintiffs who, seemingly carry around their own little jars of black mold and things like that. So it's a cool little world. And for every attorney that's out there that uses the phrase, mold is gold, there's another one like myself who's helping fight for the good guys.
That's great. Well, cool, man. Well, we appreciate you being here to tune in and just kind of add some value for future limited partners. And that's what I'm doing here today, guys. I'm asking a lot of questions that from my LP experience over the last years, I've been diving in, trying to formulate questions for anyone who needs to learn about the legal side. So what I'd love to start with, Carl, is could you just tell us a little bit about what the legal structure is of a syndication deal?
Yeah, so usually when you're looking at a syndication deal, by the way, everything I'm going to do, I'm going to sort of frame from both the legal side and the tax side, since that's the the pond I swim in. So first of all, from the liability side, usually syndications are a really good, safe way from a liability perspective to invest in a deal, especially if you don't have all of the money to take down a deal. So a lot of times you'll see them in more like multifamily spaces, commercial spaces, where a lot of people can pool their money together to buy an asset. Liability-wise or the structure-wise, usually the asset and the majority or all of the funds are wrapped up in a single entity. So usually that's a limited partnership or a limited liability company. And then you basically have two different types of ownership. You have passive investors in the deal, and then an active investor or sponsor of the deal that runs basically the acquisition and employs managers and basically takes care of the investment along the road.
Gotcha. Okay. And I know you mentioned the general partner side and the limited partner side. Could you shed some light a little bit? And Samson's going to chime in here as well about what general partners do and just like the breadth and just the weight they're carrying to make the limited partners, job easy and fun.
The general partner is the one doing all the legwork. So as a limited partner, if somebody's taking my money for a passive investment, I expect to do no work. I expect a sort of a K1 and a payment, and that's about it. The general partner is the one putting in, usually a lot of times, the sweat equity or in the management capacity for the project to make sure that during the term of the investment, number one, if there's some sort of draw or if there's a payout on monthly, quarterly, however you're going to do it, they're making sure the investment functions in a way that those payouts happen and facilitate the investment. So limited partner is pretty much exactly what it sounds like. You're really sort of as most people know it, as sort of a silent partner or the person with the money just sitting there for a return. The general partner is doing a lot of legwork.
Yeah, as I like to say, you get all the benefits of owning real estate without any of the brain damage. So it's truly passive in the sense that you're putting your money to work and you're receiving the cash flow, the appreciation, the loan pay down, as well as the tax benefits as an owner. But the day-to-day grind of operating the property, managing the asset, dealing with property managers, dealing with employee issues and all those things, that falls on the sponsorship or the active partner's responsibility. And we're the type of people that like that stuff. We like the business of real estate. We enjoy the game. And I think that's the coolest part about real estate syndication is everybody wants the benefits of real estate, but man, it is a lot of work. And that's why real estate gets a bad rap, right? People will say things like, oh, Carl, are you sure you really want to fix toilets at 2 a.m.? And that's because a lot of people who jump into real estate, they're dabblers. They're kind of lukewarm. Nobody would say, I think I'm just going to dabble in opening a McDonald's and see how it goes. You're opening a business that requires you to operate it. This concept that real estate is passive is kind of a farce, unless, of course, you're a limited partner in a larger commercial real estate investment.
Yep, and the tax implications reflect the same. So when you look at what type of tax you're paying for your investment, a lot of times it's going to come down to, are you actively involved? Or I guess if we want to use the tax code language, are you materially participating in the investment? And as a limited partner, you're not. So you get to dump those things like self-employment tax. You don't have to worry about paying that. You're literally paying your passive income rate only on the taxable income that's left after your depreciation and after sort of everything pans out. So passive income basically just means you're paying tax at your individual rate. So it's a pretty good deal. And the wealthiest 1% know passive investments are where it's at. I would never look personally at a passive investment as a get rich quick scheme. And I'm sure Samson would agree with that too. It's a get rich slow scheme, which is nice because ultimately the quick schemes are the ones where you usually go broke just as quick too. So it's a great way to get a better return, especially when you start looking at comparing between, say, something like an ETF, where you would get a very small rate of, usually a pretty small rate of return, decent for the market if you're just looking at dividend payouts. But yeah, it's a nice little, I don't know, I wouldn't call it a half measure, but it's a nice way where you can choose what you're investing in and what's right for your investing portfolio.
Yeah, just to piggyback off what you were saying, at a certain point, you make more money than you can effectively deploy on your own. And so you got to work with other really smart people who can help you deploy that capital on a regular basis.
Great. Well, we did touch a little bit on returns, versus, let's say, equities. I'd like to touch a little bit on some of these just terminologies and things as far as the structure of a deal. Carl, if you could maybe break down equity splits, preferred returns, waterfalls, just a lot of this jargon that we tend to see in the documentation for a syndication, if you could make that simple for who a new LP may be.
Yeah, I mean, the most simple way to sort of explain it is when you start looking at the PPM, private placement memorandum for the property, a lot of times you're going to see things like what are referred to as like waterfall provisions, things like that. Now we can go in, there's probably 100 different ways to do it, if not more. What it basically does is it's putting in place a way that the limited partners get paid before the general partners or equity partners. So it's a way that they get a preferred return, which is just as what it sounds like, before, say, the general partner gets paid out on the deal. So it's usually those terms are put in, they're standardized pretty much at this point, but they're put in place so that those limited partners really get that limited partner experience and that they get paid out for putting the money in.
Yeah, and there's a number of different ways that those can ultimately be structured, but there's generally what's called a promote or a hurdle that the general partner has to meet or exceed in order to make the waterfall payout in a certain fashion. So for example, it might be a 6% preferred return. And if we achieve a 15% internal rate of return, after that point, all of the cash flow will be split 50-50. There's just a number of different ways that you can do it. the benefit as a general partner to doing all this work, right? The pursuit costs, traveling to the market, building the team, employing people, raising the money, paying to put together the PPM, managing the asset, actually getting it to perform is in that promote structure. But Carl's exactly right. We always want to align ourselves with the investor and making sure that they're getting paid out first. Because sometimes as the general partner, we are putting our own money into the deal, but sometimes we're not. Sometimes we're simply finding great deals and opportunities and just running the heck out of them so that the investor can have a place to actually put their capital to work.
And one of the sort of interesting things, it's one of the things I talk with my clients about quite a bit, because really my perspective on what I do I review a lot of PPMs for my clients. And one of the funny things that a lot of people miss is the general partner is motivated to do a good job for the limited partner because they want you to keep investing. So everybody sort of thinks there's this boogeyman hiding behind the corner, like, hey, okay, I just gave 250K to this person. Now they're just going to, it's like, no, I want to keep using that 250,000 over and over and over again. So there's a built-in motive to do a good job and keep your investors coming back. So like I said, it's not a prompt or anything like that. It's just, I know from dealing with my clients, that's always one thing. It's like, well, what's in it for the general partner? It's like, well, the general partner is going to make money too. That's part of the gig, right? I mean, you wouldn't expect somebody to do a bunch of work for you and not pay them for it. But also, they're sort of incentivized to do as good a job for you as they can because they know you can take your money anywhere. So it's like any good business relationship, there's certainly a push and pull and a give and take in the GPLP relationship.
Yeah, and I think that's a big part of why we're doing what we're doing today is, in the absence of understanding and knowledge, there's a lot of uncertainty. And so if you're new to this, you don't really understand how that game works, so your default is to question everything, but if you do it once and you screw up one time, you're definitely not going to get that investor to come back again. And legally, the way that the PPM is generally structured, we're not going to get paid, so there's literally zero benefit to doing that. That being said, alternative assets, private securities, although they've been around for a long time, since 1987, under President Trump after the savings loan crisis, a lot of syndication was kind of brought back to the market, and there's still not a lot of people that understand it. And as you start making more money, you start to learn about other ways to deploy capital, and then all of a sudden you're like, oh, what's this whole world of private securities? There's better platforms now, from a capital management standpoint. There's platforms like Appfolio, there's platforms like IMS that do a really good job of giving transparency to the investor about how the asset's actually operating. And then a big part of what a guy like Bobby Shell's responsibility is to just be communicating with investors, right, about what's actually happening, creating content and keeping people in the know, because in the absence of communication, negativity will fill the void.
One thing I want to bring up and just kind of get a quick sidebar question for you guys is, a lot of syndicators, they have the exact same projections, 7 to 8% cash on cash, 15% IRR. And I saw someone on LinkedIn the other day say, why does everyone have nearly the same metrics? But a lot of these like funds or deals, when they close, it'll be like, our cash on cash was 2x that, or our IRR was 84%. Like, if we know we're potentially going to beat 15%, why is the industry standard across nearly all of these guys 15%? Like, why don't we speak a little more truthful, or does everyone just, is 15? You see what I'm saying? Like,
there's just an expectation, like in commercial real estate, if it's a reposition play where you're buying a property and you're adding some value to it, the typical expectation is 12 to 15% on an internal rate of return. If I'm moving into something like development in an unproven market, then a professional investor is going to anticipate something more like a 35% internal rate of return. But what's unique about the market, since let's say about 2017, we've seen a ton of acceleration, you go into it with very conservative projections. That's what a good sponsor and a good underwriter is going to do, is saying, hey, if worst case scenario happens, we're good. We're going to make this kind of money. But anything above that's gravy. So a lot of times you see an accelerated internal rate of return because IRR is based heavily on time. So if the projection was a 5 to 7 year exit, and in 2 to 3 years, somebody came out of nowhere and just gave you a stupid, ridiculous offer that just smashes all the return profiles, and you say, I can get my investors' money back 2 years earlier than they anticipated and double the IRR, well, that's going to make you look super good. To Carl's previous point, that's going to get the investor to come back again and do it for the next one.
Yeah. Okay. Good.
It's the old timey saying, man, under promise, over deliver.
That's right. Can't be mad getting that big old juicy check at the end. I can't wait for that day. It'll be fun. Oh man. Well, cool guys. So Carl, here's a cool one. What would you say for a new investor? What are some questions a lot of people maybe do not ask, or what should an LP be aware of that a GP may look over or not, be perfectly clear on? Like, what can an LP ask to protect themselves to make sure they are working with a credible and quality GP from a legal standpoint?
I mean, everybody out there at this point is sort of I always call them the, Google doctor or Google attorney sort of an area. One of my biggest things is, especially in the more modern environment here, is actually talk to people. Like, talk to your GP, understand who you're working with, understand their experience. And really, from a limited partner perspective, once you've deployed the capital, your question should be going in is just, what kind of team do you have in place, especially for me that I've seen in the past, with what does your tax team look like? How do am I going to get my K1 timely? Do I need to, what sort of tax help do I need, or should I looking at? And what is the scope? What's my responsibility and what's your responsibility in this? So for the most part, LP question is simple, is have your own tax professional that's giving you your own tax advice. And once you've deployed your funds, let the GP do what they do. I mean, realistically, I'm probably not the best attorney from the litigation standpoint, because number one, my firm doesn't engage in litigation. But number two is, I understand that the real way to win is not to have to go to court, because the attorney is getting paid in most cases, and there's not much there for most everybody else. So what I would say is if you've got a problem, number one, make sure you understand the route that's involved in the paperwork on how to solve it, whether it's, alternative dispute resolution, mediation, things like that. Most times there's not something that's, some sort of landslide event that some causes an issue. It's usually some miscommunication. So it's important to have that communication structure. And then, like you said, once your investment's there, if you trust your general partner, let them do their job. Don't slow them down and screw up the investment.
Yeah.
Yeah. And just to piggyback on that, I think, again, this just goes back to, people are preparing for a worst case scenario, but like one of the reasons why we like large commercial multifamily is it is very scalable and allows you the ability to withstand some of the economic turmoil. Like, for example, we saw over last year during COVID, we're effectively buying cash flow. So we're stepping into a property day one that has cash flow. It's not development where we're stepping into a property and we're trying to get it shovel ready, and 18 to 24 months later, then we'll be able to build, and another 6 to 8 months later, then we'll be able to lease it up. That's a very long time before you start actually receiving your dividend or your return. So it's you got to make sure you're wearing the proper lenses when you're sitting down and looking and analyzing the deal. The way that you analyze the development versus analyzing an acquisition and reposition is totally different. The way that you analyze a heavy value add versus a light value add, a C grade property versus an A grade property, there's little nuances to those, but at the end of the day, you're buying cash flow. And so if you have a good sponsor and you understand the business case and thesis for what they're doing, it allows you to get real comfortable. But if you're constantly a skeptic and you always are just going to have a skeptic's eye and never listen to it, well, it's going to be really hard for you to get comfortable. And that's okay. Sometimes the best place is to watch from the stands until you're ready,
And something interesting about that too is, I've done the paralysis by analysis thing myself. I'm a real estate investor, stock trader, cryptocurrency. I obviously got over it, right? But it's one of those things is you do whatever level of due diligence you can and you make the best decision you can. There's always risk. in any type of investment. That's what anybody's PPM will say. There is some sort of risk. Okay. Everybody should be aware there is some sort of risk. If anybody tells you there is no risk ever, run away. There's always some sort of risk. Now, usually, like Samson said, which is a great way to explain it, you're investing in cash flow. So if your due diligence reflects the same, or you're happy with the due diligence on that, then you make an informed decision or an educated decision to invest your money. And like we talked about, maybe hopefully when you're working with good folks, you will get outperformance of what that general number is or what that conservative number is, because over time, this is a big industry. You've heard of all the good stuff about real estate. There's lots of people in the space. So once again, it's one of those market motivating factors that, hey, if you deal with somebody who's a jerk and not telling you the truth, you don't have to ever deal with them again.
Yeah.
So.
Yeah. One thing I love about this space too is people are very well connected, and people are always more than happy to just like be like, that's an honest team. Like, I love them. I've met them at conferences. We've had phone calls together, and just the passion I feel like that's within the syndication network is just incredible, and it's contagious.
Yep.
One thing I'll add before we move on, though, a couple of things that I've kind of learned on my journey to add to what you said, Carl, is getting an example K1, I think, is good, and giving that to my tax guy to make sure he thinks that looks great. And then also asking a general partner, like, if you disappear tomorrow, who's going to run everything? Like, is someone going to cover for you? Like, if you just die tomorrow, is my money going to be okay? Do you have a good team in place? So I love that question too, where you said asking, like, who's the team that you're working with? Who's your, tax person? Who's the third parties that are auditing what you're doing? So that's good stuff.
I think most people don't realize too that a large majority of large commercial deals are joint ventures, and there's multiple general partners, and a lot of times there's key man insurance on main people that are involved, but there's just protocol and process, and the other part of that is in my opinion, a good asset manager is not also a property manager. They're leveraging third-party property managers who understand the market. And so if stuff goes sideways, like I had a health issue or something like that, the property manager is going to continue to operate and execute the business plan.
Yep.
Absolutely. Well, cool. All right. Here's one for you, Carl. REITs, and investing in syndications, like, a lot of folks, they love looking at, REIT stocks if they're new to equities, and they say, I want to get some just interaction with real estate. Oh, look at that. They've got a nice little 5% kicker every quarter, and it seems to just grow nicely. What are your thoughts, and what can you share just REITs versus syndications for our listeners?
Yeah, so REITs, I have a mixed review on. If you're looking for an ultimate, like ultra conservative investment where it's just going to slowly tick up over a long period of time, it's fine. Usually with REITs, though, something to consider is you're investing in a basket of investments. So it's more than one real estate deal. A lot of times, if you actually break down the REITs, there's like a few good investments and then some crap Wall Street stuck in there at the bottom a lot of times too. So you're investing in a basket of funds. Your rate of return is pretty well fixed. The things you run in with the stock market that are always sort of left out a lot of times when you're talking to folks is nobody ever throws those percentages in with the rate of inflation. So there could be a period of time where you actually may be losing money on the investments and it shows as a 5% gain, but over the span of multiple years, you're actually, the dollars sitting in some low interest or some low yield account or something could have worked out better. So actually REITs, like I said, aren't a bad thing. It's less control, less options, and it's literally, you'd be looking at an account sort of going up a penny at a time. I mean, I've had you can even look at things like Fundrise and stuff like that, where they advertise a sort of 10% return. At the end of the day, it's not necessarily that. And if you're only looking to, depends how much you invest, I guess. If I'm throwing $40 million at a REIT, then yeah, it's going to look like I'm getting a decent return. But most people who are limited partner investors, tends to be a little bit less. And so for single deals, you tend to turn out a little bit better on the return.
Well, and correct me if I'm wrong, but you're generally a shareholder of a company who owns real estate. You don't directly own the real estate.
Yeah, which means you don't get the tax benefits, I think is where you're going on
Exactly.
that one. Yep.
Exactly right. Yep.
Gotta love those tax benefits, man. Robert Kiyosaki hit me
Yeah.
over the head with the knowledge, and we're all in. I can see everybody laughing here. We know it's true.
Well, and I
Cool.
think, and maybe that's an interesting little topic just related to taxes and everything that's on the table right now. This isn't, general information. It's more specific to what's happening in the current tax environment. Maybe some thoughts from you, Carl, on what's going on with capital gains, what's going on with 1031s, and what that might mean for the market.
Yeah. So one of the biggest things is, and so we're not only a law firm, we're a tax firm. So we do a lot of tax work and tax planning and things like that. And the best piece of advice I can give anybody out there is don't pre-plan something that hasn't been enacted into law. I've seen a lot of people get hosed transferring a ton of real estate, selling all their stocks, and then all of a sudden, by the time the bill actually makes it through and is a law, they're fine. So just, we live in a world where the media is entertainment these days. So just be aware. My policy is don't change anything until there's actually a law passed. Don't act too proactively. I mean, Prop 19 in California is a perfect example. There was basically the law passed that you could transfer a property to your child without having the property tax step up or not having to recognize the step up in basis in California. And it was really intended to help people whose houses burned down in California fires. And so many people bid on it, only to find out that once you got through exclusion 1, exclusion 2, exclusion 3, exclusion 4, 5, 6, and 7, it didn't apply to them. And then now they've gifted a property to somebody, which is fine for the person who's accepting the gift. The downside, though, is when you gift somebody that property, they get it at the giftor's basis. Had they just passed away and, gave the property to their kids after they passed away, they would have inherited it at current market value, could have sold it that day for no taxable gain. So it's one of those things. You don't want to be, when it comes to tax rumors, you don't want to be the one that bites on it first.
Yep.
Wow. Say that last part one more time. That was super clutch on the disclosure there on when you transfer it as a gift or not.
The part about don't bite on gift.
Yeah, like if you give it, if you gave it too soon, they receive it at a lower rate. So when they go to sell it, there's higher taxes, where if it goes at death, it's actually at the current rate. So there's a tax difference there.
Yeah, big one. So there's certainly an exclusion on an annual basis, $15,000 you can sort of give to people without having to report it. Technically, you have your lifetime exclusion to give things to people. And even if it's over 15, you just have to file a form that says, hey, I gave a gift that's over 15. So the piece where you start talking about maybe family trying to give you real estate is it's actually better to get it at their death, because you get a step up in basis to the current market value versus getting it as a gift, because when somebody gives it to you, you get it at that person's basis in the property. So if mom and dad bought a property, in Denver for $50K back in the 70s, and they give it to you now, you inherit that property at $50K and say it's worth $1 million. So you go to sell it, now you got to pay the gain between 50 and $1 million. If you inherit it at their death, hopefully a long time from now, and say it's worth $2 million, you inherited it at $2 million.
And that also applies for airing limited partner positions in real estate as well, doesn't it?
It does. So there's this thing that was out there for a decade or so called a family limited partnership, which is just a marketing term. You can facilitate the same type of thing through an LLC as well. So yeah, you can inherit assets through business entities as well. IRS doesn't care. IRS, when we start talking about things like disregarded entities or entities taxed as sole proprietorships, they don't even see them. So if there's things I own that ultimately report on my personal return, I can transfer it or leave it for whomever to inherit.
Yeah, some of the wisdom that you imparted there just about rumors versus facts. In the world of trading, which is where I got started, there is a saying that says, buy the rumor, sell the fact. Because a lot of times market media news would come out and make the market tank, which was a great opportunity to buy. And 90% of the time or more, the market would recover once it actually figured out the facts of the situation. You could make a ton of money. Obviously, sometimes you buy the rumor and the facts tend to be accurate, and you lose some money, but that's why you always protect your risk and your downside. The majority of the time, buy the rumor, sell the fact works out pretty well.
Well, and going on along with that same aspect too, to Bobby, to one of your earlier points, is the market already discounts most of the news, right? So let's talk, if we're looking COVID or all these other things, people are still out there buying real estate. Real estate is actually one of those things that's interesting because in a market with inflation, fixed assets, if you're holding and at least a part of your investment plan is equity, your equity is actually getting better with inflation. I mean, certainly you got to be, if there's a crash or something, it's something to look for. But realistically, you look at all the sort of big kids we're all familiar with out there, they're not stopping buying real estate. Unfortunately, what it's actually you're seeing in some markets is with all the eviction moratoriums and things like that, you're seeing a lot of folks who are small fish in the pond getting washed out and big funds buying up all the real estate.
Yeah. Yeah. I know I've read recently just a lot of GPs, they may, not a lot, but there's some out there who will overbid for properties when the cost of capital for these large funds is much cheaper, so they can have a lower hurdle and be okay with it. Because like you said, if you have $40 million in a REIT, you might be okay with that. You're trying to preserve wealth. Someone else who wants to take on equity and participate in the upside and, not be a part of like a debt side of the deal, they want to have that upside. That's, I think, what limited partners enjoy, especially people, seeking financial freedom and just the passive cash flow like we see in a lot of these deals. So that's a good point.
Yeah, one of the things to note about large commercial multifamily specifically is, during 2008, when the entire real estate world was melting down, the default rate on large commercial multifamily loans was 0.04%. So how's that possible? It's possible because the banks are giving you large non-recourse debt, which basically means that if the world melted down and you had to walk away from the property, that nobody would be personally held responsible, unless, of course, you did something to defraud the bank, like intentionally run the business into the ground, take insurance off the property, something like that. But at the end of the day, the bank is also underwriting the deal alongside of you and dictating the type of loan and leverage that you can ultimately get. And different markets have different types of leverage. We've been looking a lot at Oklahoma City. Oklahoma City is considered to be like a secondary MSA. So they require you to have a lower loan to value ratio. And so they're going to make you maybe give you 65% loan to value versus in a market that's a little bit more predictable and stronger from a cap rate standpoint, meaning the cap rates are actually lower. They'll give you a better LTV and you can get higher leverage on those properties. So, it's when you're talking about risk and we're talking about taxes and we're talking about legality and all that stuff, it's also just important to know that the more scale there is on the asset, the actual, I don't want to say purely risk-free, but safer it gets as an asset class.
Well, and to sort of piggyback on that, really from an LP side, your biggest liability risk isn't actually inside the investment, right? I mean, say it's just a apartment complex and the tenant gets hurt. That's not really where your risk is. Your risk is, and God forbid this happens to anybody, but your wife or your wife are driving home and you get in a car accident. That's your risk. Because if I'm personally holding those investments, then technically that's a personal asset of mine that I have invested in that apartment complex. So not necessarily that they're going to be able to somebody's going to be able to get into the deal, but basically I can sue the individual and now I'm getting your and then the plaintiff is getting your distribution from that deal. So for a lot of my clients, that's what I'm doing when they're investing in syndications. That's what I'm looking at is, well, what can I set up where that's safe, anonymous, nobody can see it. I'm not going to take you offshore or do any sort of shenanigans like that. There's stuff we can use in the US for that, But that's my preference, is that for my clients too, is you can hold that interest in a retirement account. You can hold it personally. You can hold it in an LLC. It depends on your overall strategy. But the risk for most is actually what we call outside liability, you doing something and then somebody being able to step in between you and your distribution.
Got it. Okay. One final question before we wrap up. I saw some headlines today. I didn't get to read too deep because it just set me off, and I went into that non-sober, irrational mindset. But I saw something about Joe Biden wanting to eliminate suburbs if certain things are not met. Can you calm the market
Eliminate
down?
suburbs?
Yeah, something about Joe Biden in the suburbs, that if certain things are not met, we should eliminate them. And
That is, I would say that has got to be media pandering 101. Like how to freak people out. It's like that, to me, it's like that whole little thing in, what was it, in Seattle or Oregon, one of those sort of places where they took over the block. It's like, yeah, but when they wanted to take it back, they just stepped in and took it back. Right. So it's a little, I would just say it's inflammatory media. I don't know how you would, quote unquote, take away suburbs or
with the suburbs.
I think his last one was what? Great, you've got a bunch of guns, we've got nuclear weapons and
F-15.
Okay. So we've apparently jumped the shark at this point. So yeah, some of it you just got to let wash over you and keep steady, because ultimately, slow and steady. At the end of the day, what did Ronald Reagan say? The scariest 9 words out there are, "We're from the government. We're here to help." So I would turn it back and just say, the government's not going to take care of you in retirement, so you need to find some good stuff that will.
Yeah,
guys,
again, just look at the facts, right? Like, just don't get caught up in the news.
Guys, if you made it this far with us, what Carl's saying is he is your Zen master. Call him; he will calm you down.
Yes, that's a good point, Carl. How can people get in contact with you?
So what I'll do is I will set out a link, and then Bobby, I guess you could just post it with it. And then what they can do is, if they want a free consultation, you're more than welcome to click on the link. We do a ton with education. We really, if we're going to ask us what Anderson Advisors is at its most basic, it's an education company that happens to fulfill on the legal and tax side. So anybody's welcome to have a free consultation. I can't guarantee it's going to be with me, but you can have a free consultation. What we do is called a wealth planning blueprint. So we'll just draw out a visual depiction of what we suggest you have. And if that's something you're interested in or want to hear more about things like estate planning, investing with a 401k or IRA or a living trust, things like that, we've got a pretty wide array of services. Otherwise, yeah, so I'll shoot the link over, and then anybody who's interested, you just click on it and sign up for a consult.
All right, that sounds great. We appreciate you today, Carl. You as well, Samson.
Yeah,
Thanks, guys.
Thanks.